In this video, we will discuss the conceptual overview of responsibility accounting. Okay, so first, let's define what is responsibility accounting. Responsibility accounting is an accounting information system and a managerial control device that involves identifying responsibility centers with their corresponding objectives, developing measures of achievement, and preparing and analyzing responsibility reports in every responsibility centers. So for short, this responsibility accounting is actually concerned with designing reports that help motivate managers to make decisions and to take actions that are in the best interests of the overall organization. While let's have this self-check number 1. So consider the following 3 statements. A profit center has control over both cost and revenue. Statement 2. An investment center has control over invested funds but not over costs and revenue. Statement 3. A cost center has no control over sales. Question: which statement or statements are correct? Okay, so you may answer this on your own. Okay, so for this question, let's assess every statement. Statement number 1, a profit center has control over cost and revenue, and that is correct. A profit controls revenue and cost because revenue less cost is equal to profit. Therefore, profit center controls both of those variables. Statement number 2, this statement is false because it should control over costs and revenues because investment center is an upgraded profit center because it controls invested funds. So therefore, statement 2 is false. Statement 3 is correct because it only controls over the costs. It does not control revenues. Okay, so the statement should be this statement is true. No? Okay, so our answer should be only statement 1 and 3, and that is letter choice C. So let's have a self-check number 2. In responsibility accounting, each segment in an organization should be charged with the costs for which it is responsible and over which it has control, plus its share of common organizational costs. So, is this statement true or false? Okay, so this statement is false because it should not include here its plus its share. So the statement should have ended at the word control if we want the statement to be true. So if this question is considered, what makes this wrong is this plus its share of common organizational cost because the manager does not control this one. Okay, so the answer is false. Okay, so before we proceed, let's have the self-check number 3. So when you see segment margin figure, let's say 50,000, what does this number mean? Okay, so just answer in a brief sentence or just a phrase will do. Segment margin is the difference between the contribution margin and the traceable fixed cost. So therefore, when we see segment margin, this is the profit that is being contributed by the segment itself and also its share in covering its own fixed cost. So therefore, segment margin is a very useful tool in assessing the profitability of one segment. And segment margin is also the best tool to evaluate a manager's performance because in segment margin, it shows the extent of the contribution to profits that is within the control of the manager. Self-check number 4. Question. Contribution margin and segment margin mean the same thing. Is this true or is this false? So again, contribution margin and segment margin are two different things because from contribution margin, we deduct first the traceable fixed expenses, then we get the segment margin. So by that, it is false. Okay, so first, let's define what is responsibility accounting. Responsibility accounting is an accounting information system and a managerial control device that involves identifying responsibility centers with their corresponding objectives, developing measures of achievement, and preparing and analyzing responsibility reports in every responsibility centers. So for short, this responsibility accounting is actually concerned with designing reports that help motivate managers to make decisions and to take actions that are in the best interests of the overall organization. Okay, now, so let's have self-check number 1. Question. In computing the margin in an ROI analysis, which of the following is used? Letter A, sales in the denominator. B, net operating income in the denominator. C, average operating assets in the denominator. Or D, residual income in the denominator. Okay, so this is a kind of a very basic question, but sometimes this is a tricky one, especially if you just focus on the bold-faced letters. So if you don't read actually the question and just focus on ROI analysis, then you proceed to the choices, then you will get a wrong answer. So here, the question is actually the profit margin. So the question is not the ROI formula, but just the profit margin. So now we recall that profit margin is equal to net operating income or profit divided by the sales. Okay, so let's evaluate the three statements. So letter A, sales in the denominator, and that is correct. Okay, so though we know that this is correct, let's just try to continue evaluating the three other choices. Letter B, net operating income in the denominator. So this is false. This is numerator. Net income divided by sales. Letter C, average operating assets is not part of the margin formula. This is part of the asset turnover. Letter D, residual income. Residual income is never found in any formula for ROI because residual income has this is another performance tool. So residual income is never found in the ROI analysis. So again, our answer here is letter choice A. So let's have here a sample problem on computing return on investment. So the following data represent the results of operations for the most recent month of Racer Company's Dodge division. So we have here net operating income of 10,000, sales of 100,000, and average operating assets of 50,000. Required return on investment. So this is pretty much easy because you will just substitute the figures to the formula. We have the formula, return on investment is equal to net operating income divided by average operating assets. So we have here net operating income of 10,000 divided by the average operating assets of 50,000. So we have an ROI of 20%. Okay, so now let's have the different assumptions. An increase in sales from 100 to 100,000, increase in net income of 2,000. So therefore, our net income from 10,000, it will become 12,000. So it's again very simple, 12 divided by 50. So our answer is 24,000. Next, how about reduce expenses by 1,000? So again, our net operating income as of the moment is 10,000. If we reduce expenses, that would increase our operating income by 1,000, making it 11,000. So 11,000 divided by 50,000 is equal to 22%. And for the last, we reduce the assets from 50,000 to 40,000. So we have the same assumption, 10,000 net income, but our operating asset is 40,000. So therefore, our answer is 25,000. 25% rather. Okay, self-check number 3. Question. Ahmad Company's sales last year totaled 150,000 and its return on investment or ROI was 12%. If the company's turnover was 3, then its net income for the year must have been. Okay, so the question here is the net income. Okay, so what I do first is to get to read really the question, then read again from the given. So normally I start with then its net income for the year must have been. After reading that, I will go back to the question, Ahmad Company sales. So that's how I solve these kinds of questions, because it's a lot easier, because as you read again, you will spend lesser time in dissecting the given because you already know what is asked. Okay, so the net income, so we know that the net income is from our profit margin formula. So if we read, we have an ROI of 12%, profit margin, that's where we can get the information for the net income, and our turnover is given 3. So if we just manipulate this formula, we will get 12% divided by 3, and that's profit margin of 4%. So from the profit margin, we know that the formula for profit margin is net income divided by the sales. Net income is not given. Sales is 150,000. So if you just transpose, net income is equal to 150,000 times 4%, and that will give us 6,000. Okay, so now let's have self-check number 4. Question. Suppose a manager is to be measured by residual income. Which of the following will not result in an increase in the residual income figure for this manager, assuming all else remain constant? Letter A, increase in sales. B, an increase in the minimum required rate of return. Letter C, a decrease in expenses. And letter D, a decrease in operating assets. So what is asked here is which will not result in an increase. Okay, so our answer here is letter B, an increase in the minimum required rate of return. Because if you increase the minimum required rate of return, the the product of the minimum required rate of return multiplied by the operating asset is actually being subtracted. So if you increase that and that is being subtracted, the result in a residual income would be decreased. Okay, so again, our answer is letter B. For letter A, increase in sales, yes, that is correct, because our operating income will be increased also. Decrease in expenses, the same explanation with A. Decrease in operating assets, so of course, the product here of operating assets multiplied by the minimum required rate of return is being deducted. So if you deduct that or decrease that or reduce that, so we will have lesser amount to subtract. So we will have higher residual income. So therefore, letter B is the only one that will not result because it will decrease our residual income. Okay, so we have self-check number 5. The Eastern Division of the Wason Company had average operating assets totaling 150,000 last year. If the minimum required rate of return is 12%, and if last year's net operating income at Eastern was 20,000, then the residual income for Eastern last year was. Okay, so this question is very easy. So just substitute the given to the formula. So we have the formula net income less average operating assets multiplied by the minimum required return. So we have net income of 20,000, average operating assets of 150, multiply that by 12%, so you get 18,000. So 20 minus 18, we get 2,000.